Welcome to day 3 of my Trader Challenge. This is a big one today. I'm going to explain to you my 5 strategies to safeguard your mental capital and optimize your day trading performance. We understand all the risks that can impact our mental capital. I'm going to give you some ideas of how you can keep your trading under control so you don't suffer these wild swings of emotions. When I spot a trade opportunity, let's say I'm buying into a support level in a bull trend. I've seen the market correct to the downside. I've identified that there is a strong support, maybe due to a Fibonacci level combined with a trend line or a moving average, that's worth taking a risk. I can have a 30 pips stop loss, and if the trade works, I could be looking at 40, 60 pips profit. Does that risk versus reward work? Yes. If you don't understand that concept of risking less than you intend to make, let me try and explain it to you. So let's say you have a strategy that works 50% of the time, a bit like a coin toss. Over 100 coin tosses, you can expect to win 50 of them. With trading, let's say we have the same kind of ratio. If you have a 1-to-1 risk-reward ratio, in other words, if you're risking 20 pips to make 20 pips and your success rate is around 50%, which isn't uncommon for traders, you're never going to make any money and you'll end up losing money on slippage and trading costs. So we try to find a strategy that has a greater than 50% win rate. Now that only has to be 55 or, if you're lucky, 60%. While it's certainly possible, you will have periods of time when that win rate will decrease below 50%. The other thing we can do is increase our reward versus our risk. If we only execute trades where we believe we can risk $1 to make $2, you need to be risking a smaller amount than you intend to make. If more than 50% of those trades actually do achieve the target, eventually, over time, of course, we will make a good profit. Now, you will go through periods when things go wrong. You might have a week where you lose on 7 trades and you only win on 3 trades. If you lose $7 on the bad trades and you make $6 on the good trades, you've only lost $1. I'm simplifying things, but you get my point. You must always preserve that risk versus reward ratio. We all suffer the highs and lows that go with the swings of our P&L in our trading account. I'm going to look into some ways that we can try to control that and control our emotions with it. When I identify a trading opportunity, I also want to try to avoid that fear of missing out, that FOMO situation. Years ago, I used to worry that I was going to miss a trade. I may have missed a couple of trades before by a few pips. I really don't want to do that again. I'm suffering impatience. I'm watching the market come down towards my support level. My anxiety is building. I'm thinking I don't want to miss this trade. So of course, I end up getting in way too early. Eventually, the market price does come down to my entry point where I had expected the market to bounce, but because I've jumped in too early, I'm not quite comfortable with it. The market actually then drifts down to my entry point. I'm looking at a loss in my account that I really don't want to sustain if I let it swing further to my stop loss. The loss is going to be way too big because I got in too early. The other problem is that my risk has dramatically increased compared to my reward that I had when I initially calculated the trade. So how do I get around this problem? I scale in across a range. Let's say I'm trying to buy gold at $1,960. I'll scale in from 1964 down to 1960 because I know it can bounce ahead of the level or it can overrun as well. I don't know exactly where the market's going to turn around. So I'll scale in. I might execute 3 or 4 trades across that range. Now, the dream scenario is that all 4 trades get executed. We don't get too close to my stop. The market reverses and goes in the direction that I expect. And the trade goes really well, it hits my target and I get out. But there are so many other different possibilities. If I at least get hit on 1 or 2 of the orders within my buying range, I've got something and I don't suffer that fear of missing out. And that doesn't then lead to the desire for revenge trading. It doesn't lead me to start thinking the market owes me something. When you find your entry level, think about placing 3 or 4 trades across that range just to give you the opportunity to at least get some of your order executed, even if it's only a small position. The other issue is when the market is starting to move in the right direction. You're thinking about trailing your stop, maybe halfway to your entry point, and the anxiety starts to kick in when you start to make a profit because you think, I can't take the profit too quickly, we're nowhere near my target. But you're seeing an amount of money in your account that you don't want to disappear. So how do I overcome that anxiety that's starting to build as the profits build, as I worry about the market swinging back and seeing the profit evaporate? I'd suggest that you scale out as well. Maybe when you feel this desire, this anxiety build, you can exit a small portion of the trade. You bank a little bit of profit, it gives you some satisfaction, it removes that anxiety, and you can then sit back and let the trade run to the next target. If the market does swing back and reverse to your entry point, you can even re-enter that position again, that portion of the trade that you exited. So it gives you options. It gives you an opportunity to maybe scalp a little bit, but you can benefit from further moves in the expected direction of the trade. For me, it's all about just managing those emotions and not getting into a state of anxiety or frustration. You can stop trade watching, conserve that mental capital I keep talking about. There's only one real way to keep emotions out of trading, and that is to control the size of each trade so that no one loss creates any impact on your mental capital. The amount you risk must also allow you to keep yourself out of any significant emotional issues if you have 5 or 6 losing trades in a row. It's not how much you make, it's how you bounce back from your losses and how you keep things under control when things are going wrong. You take care of the losses, the profits will take care of themselves. The general rule for traders is to risk 1% of your account on every trade. If you lose 5 or 6 trades in a row, you'll only be down 5 or 6%. That is recoverable. You know that you only need around 3 trades to win and you've got the money back. Having said that, you might think that making 1.5 or 2% on a trade is not enough and it's going to take you too long to make a significant amount of money. If you're not happy to accept a 3 or 4% profit on your account in a week, you're being too greedy. Eventually, when you hit that losing patch, which everybody does, you're really going to suffer significant losses. Don't get yourself into a position where you're risking 3 or 4% on a trade. You have a bad run, and you're down 20, 25%. That really hurts. Think about where you want to be in 6 months, not in 6 days. Build your account slowly. Keep your losses under control. Preserve your mental capital. If you're worried about a position, a trade that you've executed, if you're constantly monitoring your phone, you're dreaming about the positions when you're asleep, and you're waking in the night to check the prices, this always means you're trading too large. You're risking too much on each trade. It means the size is too big. It's not because you're worried that the trade won't work. It's because you're worried about the size of the loss on each trade. You know you've taken on too much risk. You shouldn't suffer any trading anxiety if your size is under control. Build your account slowly. Compound as you make money. Now, you'll know that I go on and on about using a stop loss. The very least you need to do in order to develop a trading strategy is know where you're going to put your stop loss, because otherwise you don't know what your risk versus reward is. And if you don't know what that is, you don't have a trading strategy. I'm going to run through some points about stop losses. We don't enter trades thinking that we're probably going to lose. We have this optimism bias. That means we're pretty sure we're going to make money on the trade, which is exactly why we entered the trade in the first place. But the experienced trader knows losses are part of the job and they must be managed correctly. Inexperienced traders believe that they can trust themselves to activate a manual stop. They will stare at the screen and they will watch the prices going up and down. They believe that when the market hits their predetermined stop loss level, they will automatically click the button and get out of the trade. They think they will be disciplined enough to do this. But the experienced trader knows this is highly unlikely to happen because it is at this stage when the inexperienced trader fears they are just about to exit the position at exactly the time when the market is going to reverse and go in the direction that they expected. The inexperienced trader draws on previous occasions when the market has suddenly reversed and convinces himself it's about to happen again. He cannot bring himself to execute that stop loss and realize the loss. The experienced trader, however, knows that he must automatically set an exit when he enters the position at the predetermined stop loss level in order to preserve the risk versus reward ratio that made the trade worth taking in the first place. Experienced traders know that automatically exiting the position at the stop loss allows them to immediately move forward, preserving mental capital as well as monetary capital, onto the next opportunity that could allow that loss to be made back quickly. The inexperienced trader emotionally entangled in that losing trade, which causes the trader to start to panic, to second guess the market, just hoping that things will go right. Even if the market reverses and starts to decrease the loss, the trader's got no idea where to get out. Any decision will still be spontaneous and unplanned. And all the while, the inexperienced trader is just reinforcing bad habits that can lead to further undisciplined trading. The experienced trader has already moved on to the next trading opportunity and may be making that small loss back already. the inexperienced trader misses out on the opportunity while nursing the losing trade. Some will even decide to average into the losing trade, so they start adding to the position. The losses are magnified. We've all done this at some stage in our trading career. Trailing your stop loss in the direction of your profit allows you to reduce some of your anxiety, help to preserve your mental capital, and keep you feeling confident. I would suggest not moving your stop loss too quickly. Some like to move it to the entry point very quickly. I don't see the point of that. Moving your stop loss to the point at which you wanted to enter the trade doesn't seem very logical to me. The other important part of planning each trade is setting your targets. So again, you understand what your risk is versus your potential reward. But it's also important to set targets for your daily profit and your weekly profit. You're never going to buy the low and sell the high to catch the whole move of every trade. That is not your job. Your job is to take small amounts of money consistently off the table and grow your profit steadily. Set yourself a target. Be happy when you've hit the target for the trade. Be happy when you've hit the target for the day, and be ready to start tomorrow feeling confident. I've talked about stop trading on a Thursday. If you've hit that target for the week, come back on Monday feeling confident.